Hey everybody, welcome back to the Financial Freedom Show. My name is Rob Berger, and I'm sporting a t-shirt today, not my normal button-up. I don't know what that means exactly, other than perhaps all the other shirts were dirty. I don't know. I'm just spitballing here. Could be a possibility. And I already see some great questions in the chat. If you're new to all of this, just tag me in your question or topic you want me to cover, and that way I'll find it. If I don't see my name in there, I skip it. And I will do timestamps, hopefully by tonight. That's sort of the goal. The other thing I think I'm going to do, by the way, is I'm going to start you guys ask some really great questions, and I find myself answering the same or similar questions over and over again. By the way, not even from you guys, just like from emails that I get and other things. And so I think I'm going to start taking some of the questions that that a lot of people will tend to ask, including the one we're going to start with, and cutting it out of this live stream and publishing it as a standalone video. And so you'll see those in the stream if you subscribe. And if you've watched this, you don't have to watch it. Although I don't know, maybe I could say something different. Although I plan just to cut and paste, so I don't think so. That's what we're going to do. And the first question, there's actually a number of questions in the chat that relate to this that we'll cover. But here's the basic question. How do we go about thinking through tax-efficient investing, not only in a taxable account, but also, frankly, in a retirement account? So I want to walk through that. And I think the starting point is to recognize that there's really three different types of accounts. It's not just taxable versus retirement, right? There's what I'll call traditional retirement accounts. These are pre-tax. We get a tax benefit, a deduction, when we make the contribution. So think a traditional 401k or 403b, workplace retirement account, or a traditional IRA where you take the deduction for your contributions. So that's one bucket. Then there's Roth, which if we follow all the rules, when we take it out in retirement, we don't pay any taxes. We don't get a tax benefit when we make the contribution, but fast forward to retirement, we take it out, it's tax-free. And then there's your plain old brokerage taxable account. And so there's a couple of sort of rules of thumb I follow to try to make it as tax efficient as I can. So the first one is, I personally never will put a REIT fund, that's a real estate investment trust fund, in a taxable account. Why? They throw off a lot of income, and there's reasons why they do. They get certain tax benefits if they distribute 90% of their profits every year. And effectively, they don't have to pay tax at the REIT level. Remember, corporations, of course, pay tax at a corporate level. But for a REIT, they can avoid that. So they distribute a large percentage of their income, and it's taxed generally as ordinary income. So you don't even get long-term capital gains treatment. So I don't put REITs in a taxable account. That's number one. And then I don't put municipal bond funds or tax-free. Not literally tax-free. It could be state taxes, but tax-advantaged bonds, municipal bonds, in a retirement account, because you're paying something for the tax benefit, and what you're paying is lower yields compared to comparable regular bonds. So you're getting a slightly lower yield, but you're willing to accept that because you're not going to pay, say, federal income tax on it. Well, that doesn't do you any good if you stick it in a retirement account, right? So I don't put any municipal bond funds in a retirement account. And I've had folks email me, and their advisors have put them in an IRA in a municipal bond fund. And I just don't think that makes any sense. Now, beyond that, though, I think there's another aspect to this that's really important. I try to put all of our fixed income, so bonds, in traditional retirement accounts. Could be a 401k at work, could be an IRA. And I'll explain why in a second. To the extent you have Roths, to the extent we have Roth 401ks or IRAs, I want to put investments that have the highest expected return. So for me, the first starting point would be small cap value, or small cap, stocks, or just regular, U.S. total market. You could put REITs in there. Even though international stocks have underperformed relative to U.S. stocks, I think argument can be made to put some international in there. But the point is, as I've said, I want the Roth to get as fat as a tick. And so I want it to grow. And then in my taxable accounts, again, I generally try to avoid fixed income as much as I can, even with yields so low. Although I do have municipal bond fund in my taxable account, so that that's I do have that. But for me, just sort of a low cost stock index fund is perfectly fine in a taxable account. The dividends you'll pay, say on a VTI, Vanguard's Total Stock Market Index Fund, it's around 1.2% right now. I mean, it's and you're going to get long-term long-term capital gains treatment for the qualified dividends, and so it's fairly tax efficient, and I'm comfortable with that. Now, going back though to why do I put fixed income in traditional retirement accounts as much as I can? It's because, even though this may be a long time away for you, eventually you're going to get to that age, currently 72 for most, where you're going to have required minimum distributions. And I would prefer to keep that balance as low as I can. Now, obviously, you want your investments overall to grow as much as you can, but to the extent you have fixed income, long term, I'm not expecting them to grow as much as stocks. So put that in a traditional retirement account, and your required minimum distributions won't be as large, and it'll help you manage the tax burdens of RMDs once you get into retirement. So I want my Roths to get as fat as a tick, so stock index funds go there. I want my traditional accounts. You want them to grow, but to the extent you're going to have fixed income, they go there because of required minimum distributions. And then in a taxable account, you could have municipal bond funds, and for me, just stock index funds. I own an international stock index fund in my taxable account. I own a total market US VTSAX, and I own a small cap fund, and they're very tax efficient. I'm very happy with how they've performed, and from a tax perspective, no complaints at all. And so there you go. That's it. That's sort of in a nutshell my approach to tax efficient investing across all of the accounts. Now, having said that, the very first question from Arun, and he asked this at 10:11 a.m., 49 minutes before this show started. That's dedication. Hey, please include comparing Vanguard tax managed funds. Well, perfect segue. Vanguard has 3 tax managed funds versus Vanguard other funds, different types of tax exempts, reduced capital gains, etc. So yeah, they do have 3. I looked them up. I actually saw that question when it came in, and I think my numbers is the same as his. I think there are 3. I think there's a balanced fund. There's sort of a large / mid cap fund, which we'll look at, and I think they have a small cap fund. And so, what's it mean to be tax advantaged? How does Vanguard make a fund that's tax advantaged? Well, in the balanced fund, one of the things they do is use municipal bond funds. Remember, a balanced fund is a fund that has both stocks and fixed income. For the fixed income, they were using municipal bonds. And then for stocks, they'll often just try to tilt the portfolio towards stocks that don't pay as much in dividends. So here is, let me just show you, it comes up on the screen. Here we go. Here's the Vanguard Tax Managed Capital Appreciation Fund. Let's see, here it is at Vanguard. And you can see, let's see where it is. What they try to do, and I know I read this, maybe it's under portfolio, where they said they try to avoid, or maybe I just missed it, but they invest in stocks that don't pay quite as high a dividend. Oh, here we go. Minimizing taxable gains and dividend income by purchasing index securities that pay lower dividends, right? Now, my initial concern with that would be, well, wait a minute. I mean, I appreciate paying as little tax as I can, legally, of course. But what I really care about is performance and after-tax performance. And so will this hurt my total returns? Well, recently the answer would be no, and I'll show you. So here again is that fund in Morningstar. If we look at it from a portfolio perspective, I mean, it doesn't look much different than a S&P 500 or a total stock market. I mean, it's a large cap blend tilted towards growth, which these index funds right now generally are. And if we go to the VTI, which is Vanguard's just total stock market, I mean, it's pretty much the same. It's a little, the market cap is a little lower than here. And this one is tilted just a tad more towards growth, not much. It's almost hard to see, but it's tilted a tad more towards growth. And that kind of makes sense if this fund is trying to avoid, not by the way, it doesn't avoid any stocks that pay dividends, but it has whatever its approach is to try to decrease the dividends and avoid maybe stocks like maybe, I don't know if they have, I'm guessing they would avoid like an AT&T or something like that. So because it's tilted just a tad more towards growth and just a tad more larger in terms of market cap, if you look at its performance over the last few years, it's actually outperformed VTI, not by much. And I'll show you that. So here's its performance. Well, we can look year to date, it's lost 10.57. I didn't actually look at year to date. So let's see what they are. Yeah, and this has lost 10.59. So we're talking 2 basis points. Last year, this is VTI again, right? Yeah. VTI 25.67 versus 26.87. 2020, it was 21.07 for the tax managed versus 21.03, 4 basis points. So it's done very well. I suspect if we rotate out of growth and into value, which is kind of happening now, I guess a lot of different things are happening now. Some days I think that's happening, some days I don't. In any event, I could see the tax managed fund maybe slightly underperforming VTI. So at the end of the day, for me, I'm perfectly fine with VTI. I mean, the tax difference, you can look, if we go back to these funds, you can look at the distributions. And what you want to do when you look at this is, so like last year, this is VTI, it distributed $2.93 in dividends. That number by itself is meaningless. You want to divide that by the NAV, right? So if this is going to be a little over 1%, probably, I'm going to guess 1.3, but I'm actually cheating here and trying to get the calculator up on my phone. Here we go. You math folks will be faster than I am. 2.93 divided by 242.96 is 1.2%. That's really the number you want to look at, right? So 1.2% of your assets in that fund, would have been distributed as dividends. If we go to the tax managed fund, we get 258 divided by 249.2. It's just basically 1% or 1.03. So it is more tax efficient by a smidge. It's a little bit, and it's equaled the performance or even slightly outperformed over the last handful of years. So I think they're good funds. I've never invested in them. Not that really means anything. Okay, and then so let's see. I'm gonna skip a couple. I'm gonna come back, but I started. Let's see. This is from Scott. I started and stayed with a simple 2-fund portfolio since 2007. It's a 60-40 split, 60% stocks, 40% bonds, and it gives me the tickers, and has outperformed both the 3-fund and Betterment Core portfolio. Well, look at you. Well, I'll be the judge of that. Let's just pull it up. It's funny. I've actually got the Betterment Core portfolio up here, and I've got the 3-fund portfolio. Now, you had a different allocation. So if I were going to compare yours, so you use VEIRX, and you had 35%. You said 60-40, but it looks like it's a 65-35. Or maybe VWIX. No, that's right. Anyway, VWIAX. Oh, I see, because it's Wellesley. So it's a balanced fund, 65. So I'm going to do the 3-fund. So you said it's 60-40. So I'll put 40 there. And I'll put 40 and 20. And I'm going to ignore, to change the Betterment portfolio would take too long. I wonder, one answer, by the way, to your outperformance could be lack of international exposure. Does Wellesley have VWIAX? Maybe it has some international. I don't know. Let's see. I just don't know. No, it has almost no international. So what I'm going to do, we'll clear this. And what we're going to do is we're going to recreate the 60-40, or the 3-fund portfolio, but we're actually going to get rid of the international. Just as a comparison, right? And so this we can call it, we'll call it the 2-fund, right? This is the 3-fund, and this is Scott's portfolio. All right. Whew. I think I did it right. Good chance I didn't. We'll see what happens. So this takes us actually back to 02. And well, since then, yeah, see, this tells us all we need to see. So your portfolio's obviously done very well. Actually, the 2 funds slightly outperformed. This is since 2002. I think you said since 2007, but it's international. That's the difference. I mean, and that's an important point. You know, it's important when you're comparing things. And one thing, like the tax managed fund, slightly outperformed the total market. So the next question is why? And I think there it was because it's slightly tilted towards growth, not by much, but it didn't outperform the total stock market by much. And then you can assess for yourself, okay, well now what do we do? What do we think that's going to continue? Do we care? They're pretty close. Same thing here with Scott's portfolio. It doesn't have much international, hardly any international exposure at all. As you guys know, I'm a big believer in having international exposure, but some guys like Bogle and Buffett would disagree with me. What do they know? Anyway, so yeah, I think that's the explanation. And you've done great. Congrats. Salty, welcome. Glad to see you here. I'm having problems playing the London system. Well, who ain't, really? Do you have any investment advice on how to play the opening? Okay, so I know we're all here for a financial show. Just bear with me. Just be a couple of minutes, I promise. Here's my analysis board. So I don't play the London system is, let's flip the board, is a system for white. But I play against it, and it's a D4 system for white, and it often goes, sometimes they'll get right to it. And I always play this. Let me actually turn off the engine for a second. And there are a lot of different moves. A lot of times I'll see something like this. I always play knight C6 right away. You'll get C6 in. And here, this is interesting. The next move right here for white, a lot of times I'll see this. We'll do knight F3. I come here with my queen. They go here, which I think is a mistake. Not a mistake in the sense of like they're losing, but you can already see the evaluation is in favor of black. And the issue is this. You push, the queen drops back here, and then black has this shot. And white can't take that bishop, because if he does, black comes in here and takes this pawn and wins the rook. So white often ends up here, and black's just got a nice advantage. So so Salty, there's 2 ways to avoid that problem. One is to delay the knight F3 and maybe start here with like a knight D2, or you can play knight F3, right? But when I play here, yeah, you can see the engine. You want to go here. And now this move doesn't work because I haven't pushed this pawn yet. Remember, I pushed the pawn, which kicked the queen. And so now white can take, and now I can take here, but they're going to take back, and it's a mess. And white's already got an advantage. And by the way, if you do play here, if I do play here and you go here, and then I push, you could say, well, wait a minute, I could just take your queen, but you can see the evaluation. This looks bad maybe because of the doubled pawns, but this actually already favors black. I mean, again, black's not winning by any means, but white should have the advantage after 5, 6, 7 moves, at least a slight advantage, and then they don't. So there you go, Salty. See, now there you go. This is an all-purpose show. Chess, fitness, nutrition. Okay, back to finance. Let's see. DJ, where's he from? Good morning from A2. Maybe that's Ann Arbor. Oh, you guys are clever up there. Anyway, Isn't BRKB a good long-term investment in a taxable account as they don't pay dividends? Is investing, dollar cost averaging, every week too much? Is monthly better? Well, those are two very different questions. I think BRKB, which is the B shares of Berkshire Hathaway. So just as a background, companies can have different share classes. Google, for example, has different share classes. Berkshire does too. And in fact, if we look at it, I'll pull up my stock app and show you because I have them both here. So BRKB is right here. It's currently trading, you can't see this because it's too small, but about $324. And that's what I own. And that's what VJ's asking about. BRKA is trading at $486,000 per share. Yeah, Buffett quite famously does not split the A shares. And in this case, A shares are the only ones that can vote. You can't vote your B shares. But they're worth the same. Obviously, B shares, a single B share it represents a smaller ownership in the company than a single A share. I think it's 1/1500th of an A share, I think. Well, we could do the math. In any event, there's two reasons apart from Warren Buffett that I really like Berkshire, and I do own the stock. Is one is VJ mentioned, they haven't paid a dividend. They don't pay dividends. That could change, and I would be okay if they decided to do it. To me, it's a question of capital allocation, but they don't pay dividends, and so it's a very tax efficient. Basically, you only pay taxes when you decide to sell. You have complete control over the taxes, and it is a very diversified company. In a way, it's like a large cap mutual fund. Except unlike most and it's an actively managed one, right? Except that unlike most, or maybe all other actively managed funds, it has Warren Buffett. Okay, but let's even put that aside. They can buy whole companies, right? They buy operating companies where they control the company, the cash flow. They obviously own stocks as well. But I mean, they have railroads, energy company, utilities, obviously a lot in the banking and finance. They own Geico Insurance. They own Dairy Queen. I mean, who doesn't like a good blizzard every now and again? So I think it's a great investment for long-term buy and hold investors. And I may be going to the meeting this year, end of April. I still haven't officially decided, but in terms of dollar cost averaging, I don't really have a strong view weekly versus monthly. I guess it just depends on your cash flow, right? So, all right. Neil wants to know, how soon will we hit stagflation? Hang on, I'll have that for you in just a minute. Let me punch in some numbers in my calculator. Divided by 4. I have no idea. No idea. And I've heard differing opinions on whether we will hit I don't even know what the official definition of stagflation is. Like, how high does inflation have to be? How low does growth have to be? Maybe there's an official definition. It is a miserable time economically. And you can have high unemployment while prices are going up, right? And it was driven by oil, or a large part of it. For those of us, old like me that remember all of this. I'm still not sure what's going to happen with the oil market. I mean, we don't know how long is this war going to go on. Will it reach some kind of peaceful, hopefully, resolution sooner rather than later? And could the oil markets stabilize? Let's see what the price of oil is today. It was up to like 120 or even more than that. Crude oil. Yeah, it's down to 110. WTI anyway. Brent is 113. I say that like I know what I'm talking about. If you said, well, Rob, what's the difference between WTI and Brent crude? I don't know. One of them's West Texas, but beyond that, I don't have a clue. So I'm not convinced we'll hit stagflation. I don't, and frankly, so this is actually a good question, because there are those that think they can predict that, and those that know you can't. And I just don't think that's the kind of thing you can predict. There are plenty of people predicting it or not. And eventually, some number of them will be right, and most will be wrong. And the ones that turned out to be right will get showcased across, Market Watch and CNBC, and this so-and-so predicted stagflation, and it'll make it sound like these things can be predicted, and they cannot, in my humble opinion. Okay. Jock Doc. For the retirement planning guidebook, and we talked about this on the last show, but I'll just, for those that maybe didn't see the last show, retirement plan. By the way, I mentioned this on the Monday night stream, but this upcoming Monday it's going to be like a working session. I'm tired of doing all the work. Sure, you guys type in a few questions now and again. How hard can that be? So we're going to go over the new retirement tool, which is this. This is a demo version that I use. And we're going to walk through it. We're going to spend the time talking about the tool, but also really talking about the issues that come up with this. Everything from Social Security, estate planning, estimating expenses, healthcare, Medicare, all kinds of good stuff. Anyway, the Retirement Planning Handbook was written by Wade Pfau, and here it is. And I mentioned it. You can see I bought it last December. It just came out. I don't know when, it wasn't that long ago. Good book. Anyway, back to the question. It says, great insight on one's personal investment idiosyncrasies. Have you taken the RISA advise all to look into it? No. Yeah. It is a good book. And the RISA, I'm pulling it up. I don't know if this is the only site, but I'll show it to you. I've not taken it. But it's the Retirement Income Style Awareness Profile. I don't know if this is where you can actually take it. Maybe you have to get the book. But you can Google it. Maybe I should before Monday's show. Okay. Prescott, if I purchase a Vanguard ETF through my CS account, I don't know what that is. What's a CS account? It reminds me of a funny story that I got to tell you. What does CS stand for? Well, you guys will have to tell me. So in high school, I got admitted to Brown University for a summer program. It's in between 11th and 12th grade. And I'm a kid from Ohio, right? I hadn't traveled. Travel was getting in a car and going to a lake to fish. And it may have been the first time I ever flew on a plane. In any event, we get to Providence, and I'm with two good friends, mom, a dad. My mom didn't go. They're just dropping us off. And my friend's father's trying to rent a car, and he doesn't have a credit card. I mean, remember, this is in the 80s. People didn't carry Visas and MasterCards like they do today. And so some guy from Providence was trying to help. And he said, well, don't you have a CS card? And I'm standing there, I look at my friend, like, what the heck is a CS card? I kept saying it over and over again. Well, he was saying Sears, but like they say it in Providence, apparently. Anyway, back to your question. What's a CS card? I don't know. If I purchase a Vanguard ETF through my CS account, will I pay additional fees other than the 3 basis points total expense ratio or whatever it is for the ETF? I don't know, Prescott. Someone's going to have to tell me what a CS account is. I'm sure it's obvious, and I'm just dense. All I can think of is computer science. So, I don't know. You guys, I'm sure, are all making fun of me. Look at that old guy. I don't know what a CS account is. What a moron. Yeah, that's okay. Paul says, I believe this is Paul the dentist. Following up on our discussion with 4 accounts with large number of funds, easiest way to figure up how to allocate the 80-20 across all accounts and which types of funds in each account. Well, I kind of covered that at the start of the show in terms of taxes. So again, the 20 for me would go in a traditional retirement account, and then I would make sure to put basically the rest can go wherever there's left, right? Certainly you want stocks in a Roth. I think stock index funds are very efficient in a taxable account. You could go with one of the tax managed funds that Vanguard or others offer, perhaps. If you have REITs, they would definitely want to be in a retirement account. That's really it. By the way, when we look at new retirement on Monday, you'll actually see the relevance of all of this because, and I'll actually just give you a brief idea. So in this, I have to build this out more for Monday, but when you look at the accounts, right here, you can put, right now there's just a tax advantaged account. This is a traditional, right? And so let's imagine that we have traditional Roth and taxable, and we're putting most of our fixed income in traditional. Now, we may have stocks in there too, but let's say it's 50-50. We put all our fixed income in there, and then, we still have money left over to invest, so it goes in stocks. That's going to affect this rate of return. So because in new retirement, you set an optimistic rate of return and a pessimistic one. And we'll talk about all that on Monday. Well, if this is predominantly bonds or a lot of bonds, 50-50 or whatever, maybe this optimistic rate goes down to, I don't know, 6, we'll just say, and this goes to 3, just making up numbers at the moment. Well, when you do that, obviously it affects, your account balance over time, but it also affects your RMDs because the built-in assumptions for this, depending on whether you pick the optimistic, the average, which new retirement just calculates for you, or pessimistic. So remember, we put in optimistic and pessimistic. You change these, and your projected RMDs change significantly. And when you do that, it also can change the Roth conversion analysis. So where you put investments can have pretty significant effect on a lot of different things, and you can model all of that in new retirement. Of course, you still have to make assumptions, right? All right. G. Branding says, I received a custodial account from my parents that is 100% FGRIX. Oh, Fidelity Growth and Income. Okay. It's about 25% of my total portfolio. Should I keep it or sell and use proceeds to my target allocation? Well, so if you sell it, to me, the big question is taxes, first of all, right? If you sell this, I'm assuming, it depends what gains you have in it. This is certainly a good fund. I can show you. It's not, it's not the kind of, if I was starting from scratch, this is an actively managed fund. It's got a expense ratio of 59 basis points, which for an actively managed fund is not bad at all. If we look at the portfolio, growth and income often means some fixed income. It doesn't necessarily, but it can. It doesn't. So it just means probably a higher dividend yield than the market as a whole. Yeah, 2%, but that's still not outrageous, right? What I mean by that is from a tax perspective. So if you go to distributions, this is how I would think through it in any event. So they did throw some capital gains at you last year, and that might be unavoidable. You're looking at, we'll call it $3 total on $50 NAV. So not the end of the world, but you'd prefer to be more tax efficient. So to me, the question would be taxes. If I held this account and selling it would trigger a ton of taxes, I'd probably either not do it, or depending on my tax situation, I might do a little bit over time. Depends. If depending on income, could I be in a 0% capital gains bracket potentially? 15% bracket is pretty large. But it might just, so I may or may not do it over time. Also depends, do you have losses from some other investment that would offset some of the gains? But that's how I'd be thinking about it. You could certainly, if we go back to this fund, you could certainly work this into just about any asset allocation you want. You got to do some number crunching because 13% of it's international. it's kind of easy when a fund just covers one asset class, from a management perspective. That's what I prefer. But still, it's not that hard, right? So you could work this in as part of your stock portfolio and still do an asset allocation across all your different accounts. So hope that helps. That's my opinion, my 2 cents. Gus wants to know, he says, recently I sold funds in my retirement accounts. Is there any reason to keep track of the cost basis? None that I can think of. Maybe someone in the chat can tell me why I'm wrong, but you don't use it for anything. It's not that I know of. Alexander, thoughts on Munger, referring to Charlie Munger, Warren Buffett's partner at Berkshire Hathaway, buying a bunch of Alibaba in December. Not really. I mean, I don't, well, I have thoughts about everything. Doesn't mean they're worth anything. I wanted to see, let me look it up here and I'll put it up on the screen. I want to look it up in Yahoo Finance. So he is, and here it is, he's a value investor, right? So if he's buying something, it's not because it's the latest fad or, because all the kids at school are talking about it. It's because he thinks the price at a minimum is equal to the intrinsic value, but he's going to actually try to find something that he thinks is below the intrinsic value of the company, right? And so if we go back, I'm just curious. I mean, it's obviously had a bad time in terms of stock market, right? And in fact, you say he bought it in December. So let's see. Yeah, so he's, it's even lower today. So it's interesting. I may take a look at this company, and maybe report back to you. One concern, obviously, is that there's so many unknowns that could affect this company. But my guess is the way I think Charlie Munger would think about it, like I can tell you how Charlie Munger thinks, but I'll do my best here, is he came to the conclusion that, I don't know that I remember him doing this. So he bought it at 111, you said. So he got it like right there, I guess that's November. But any investment has uncertainty, right? There's always, I own Berkshire. There's uncertainty. Who knows? Apple, I mean, it's been a great company, but who knows what the future is? But with investing, what you're trying to do is get a good company at a price that's low enough that you say, look, yes, there's a lot of uncertainties, a lot of things could go wrong, but I think given the price I'm paying and what I think the value of the company is, I got a wide margin of error. That's what you're hoping for. I've got a wide margin of error, and that's what he thought he had. Otherwise he wouldn't buy it. Now I will tell you, I mean, it's basically a 5-year low. Let me put it back on the screen. I mean, it was basically trading where it is now, not a decade ago, but many years ago. So I don't know, it could be a great investment. I've not looked at any of its financials. Maybe I'll do that this weekend. By the way, I think in terms of picking stocks, I do think that it makes a lot of sense to follow value. Well, I'm a value investor. So if you're a value investor, follow value investors for ideas. You should never buy something because they've bought it. I mean, first of all, they may have paid a very different price. You never know what they're shorting, right? Because that's not disclosed. So you never know what's really going on in their portfolio as a whole. But I think it is a great place to get ideas. James wants to know about the stock ZTS, and I have no idea what that is. Have I ever considered it? I have not. I've never heard of it. Sorry, James. Okay. Bobby says, I have an old 401k. It's got RFHTX. Should I leave it where it is or move it to something else? Well, I don't know. Let's look it up. So, by the way, before we even look it up, let's sort of tear that question apart a bit. Think about all the things we would need to know if we wanted to answer that question for ourselves. Of course, if we were answering it for ourselves, we'd know these things. How much do you have in that 401k? Is it a traditional or a Roth? How much do you have in other retirement accounts? How much do you have in taxable accounts? How much are you saving each month or year? How much debt do you have? What's your income? How old are you? When do you plan to retire? Right? There's all these questions that would go into answering what should my portfolio look like. Oh, this is a target date retirement fund. I mean, this is American funds. And so it's a little more expensive. This is probably a pretty decent fund, is my guess. We could compare it to another 2045. So we could take this ticker, right, and back test it. So we could come back to Portfolio Visualizer. Let's clear out everything. And we'll put it in here. And let's see if can we do Vanguard 2045? Will it pull it up? Oh, look at that. This is institutional. R6, I think, is an institutional class share. I could be wrong about that, but that's what we'll look at. All right. So we don't have much data. Maybe because maybe I'll switch to 2045. I need to rename them. Let's see if we can do a different one. Vanguard, let's do the other one. Maybe it's been around longer. The difference, by the way, would likely be expense ratios. So this is American funds. This is Vanguard. And Scott, there you go, buddy. All right. So American funds has outperformed again. We're looking at what? 12 years. Now, again, the question now is why. First of all, the outperformance hasn't been ginormous by any stretch, but you want to know why. But I mean, if it's keeping pace with basically a Vanguard index fund, that gives me some confidence. I would dig into exactly how it invests. Here you could go to Morningstar, the portfolio. The first big question you'd want to answer is, do these two funds have the same stock bond allocation? Because maybe American funds is achieving a slightly higher return because it's taking on more risk, right? That'd be the first thing that I would look to. So if we come down to portfolio, it's roughly a little over 10% fixed income, which 2045, I'm going to guess Vanguard is similar to that. Could be a slightly less risky, maybe, but they're basically 90-10 until you get, I think, around 20 years out. But I could be wrong. So it's a little more conservative, not by a lot. It's got 11, 13, 14% in fixed income and cash, 14. This one's got 12. It's about the same, actually. Pretty close. And the stock portfolio is fairly similar. So I like that fund, Bobby, for what that's worth. Okay, Benny. Thanks for all your videos. Love the content. How would you allocate an HSA across the following options? And it lists 4 tickers. I'm in my 30s trying to save these funds for later. Okay, so you're not going to spend them on medical for now anyway. This is part of retirement. You'll spend it on medical at some point down the road, and could also, I suppose, take some out for non-medical. You'd want to wait till you were 65 to avoid the 10% penalty. 65 for HSAs. So again, the first step, and we'll look at the funds, I'll mention them in a minute, but the first step is to figure out your overall asset allocation across everything. And I include HSAs in my overall portfolio mix. And then because HSAs have such good tax advantages, to a point, I want to put stock funds in them. Now, why do I say to a point? Because they only have great tax advantages if you use them for qualified medical expenses. If you build up a huge HSA and you end up not using it all, and of course it's hard to predict. You don't know your health. You don't know how long you're going to live. So we're all guessing at this. but they're not great for inheritance. You'd much rather have loved ones inherit a Roth than you would an HSA. There is no, there's an inherited IRA. There really isn't an inherited HSA. They just get the money and they get taxed. And if you take it out for non-medical reasons, you can do that. You get a 10% penalty unless, I'm pretty sure the age is 65. But even if you're 65 or older, you don't get the 10% penalty, but the money gets taxed. So in that sense, it becomes more like a traditional retirement account. So to a point, you want it to get pretty big. By the way, again, these are things we can talk about on Monday, because new retirement models medical expenses, it models Medicare premiums, and all of this is relevant. And by the way, the numbers that they model, of course, it assumes you live to your planning age, which might be in your 90s, but boy, numbers get big. Anyway, so here are the funds that you're mentioning. And the first one is just, this is S&P 500, right? Yeah. So Vanguard's S&P 500. That's one option that Benny has mentioned. Obviously, a great fund. I think it'd be perfect in an HSA, but again, for long term, but it's got to be part of an overall asset allocation, right? VXUS, which is just Vanguard's international, total international. So in other words, it includes developed and emerging markets. That's a good fund. The other two, I don't know, at least I don't know the ticker off the top of my head. One is VMCIX. Oh, okay, mid-cap. Perfectly good fund for mid-cap exposure. Low cost, 4 basis points. Again, you need to make it part of your overall asset allocation. But and the last one is small cap, I think, right? Yeah, small cap. Same thing. These are all good funds. I think the bigger issue is what's your overall asset allocation. Having these funds in an HSA, I think any of them would work. Again, at some point, in theory, your HSA could get to a point where you might want to throttle it back a bit. Again, figuring out when that is, and I haven't figured it out. I know I'm not there yet, so I guess it's not a worry. Most of us probably won't. I mean, you can only put so much in each year. Anyway, all right. Ra says, you mentioned Fidelity was a good place to transfer HSA, but seems to have mostly high-cost choices. Only see S&P 500 as choice. Do they do Vanguard in kind, as that is... Okay. You can invest in anything, pretty much, in a Fidelity account, whether it's an HSA or otherwise. So you can invest in a Vanguard ETF. If you're not at Vanguard, you're at any other broker, you probably want to stick to ETFs because there's probably going to be a fee to buy the mutual fund, but that's okay. So, and by the way, Fidelity has excellent index funds. They're cheaper than Vanguard. We're talking, a basis point, but Fidelity index funds are excellent. So I think that would be perfectly fine. But yeah, you can buy all the ETFs that Vanguard offers. I mean, I say all. I don't know, maybe there's an exception, but and I like Fidelity and Lively are the two that I like for HSAs. And basically because the accounts, there's no expense and there's no fees, and you can invest every dollar. Some HSAs limit you. You've got to keep 1,000 or 2 in cash and can only invest the difference. And if you're a long-term investor with your HSA account who wants to keep money in cash, so I think both of them are good. But yeah, you can. I'm pretty sure. Well, I know you can invest in just about anything in an HSA at Fidelity, and I do. Russell wants to know what keyboard I'm using. Well, I've got 2. This one is an, I think it's an F96 keyboard. They have an affiliate program. I should get an affiliate link, and because everyone asks me about this keyboard. I don't know. You could be talking about this one over here. I mean, who knows? I can make tens upon tens of dollars. Here it is. That's my keyboard. Yeah, I like it, and it's clicky, which I prefer typing on that. This one, the other one, let's see. Let me hit that button and show you. Is a gaming piece, gaming board from. It lights up. I don't know. It was part of the system I bought, which was from iBuyPower, which has been a great system. I bought it when you couldn't find anything. Computer. I was going to build my own. I couldn't get graphics cards. All the stupid Bitcoin miners were buying them all. So I had this argument with not an argument, a discussion with my friend Joe. I've mentioned Joe. He's the options buyer. He's got his puts in. He can't believe I'm unhedged. I'm like, did you say unhinged? Unhedged. Okay. I said, I'm fully hedged. It's called patience. Yeah, he didn't buy that. And I don't even remember why I brought him up. Oh, he's fully hedged. So we were having that discussion. Oh yeah. He doesn't like when people criticize crypto generally because of the energy it uses or because of the criminal activity it supports. And he says to both of those, he says, look, printing money, tons of energy, and far more criminal activity is undertaken with dollars than crypto. And I'm like, yeah, I get that, Joe, but dollars have a real meaningful purpose in life right now. We use it to buy bread and whatnot. Crypto, as a practical matter, doesn't. Yeah, we just sip our coffee and stare at each other. He thinks I'm either unhinged or unhedged. I'm both, perhaps. Okay. Justin wants to know thoughts on how to figure out your international allocation percent. Yeah, it's kind of just let's broaden that question. How do we figure out any of our allocation percent? I mean, how do we figure out our stock bonds? Once we have stock that's set, how do we figure out what goes in U.S. versus international? Do we put anything in small cap? And if we think about that question, how would we forget the answer for a moment? Just how would we go about trying to answer that question? Well, one answer, one approach would be, we're just going to look at the history. We're going to look at historical data. We recognize history doesn't repeat itself. Maybe it rhymes. I don't know. Some guy said that. In any event, what else do we have to go on? So the first problem we encounter is what history do we look at? How, we can go to Portfolio Visualizer. We can go back X number of years. Do we go back 10, 20, 40? What's the right time that we look at? Because that could change the results. But the second thing is that if you do that, like people say, well, I don't have international because if you go back and you look, U.S. stocks outperform. And so okay, well, what are you in? And then, I'm in VTSAX. Well, if you're using historical data, and I get that, it makes sense. Why not go small cap value? I mean, it clobbers the U.S. market as a whole, clobbers it. Let's take a look. Take a look-see. We'll go to the asset allocation, which we'll just use asset classes because it goes back further. U.S. stock market. There we go. We'll even do large cap, which is the S&P 500, and then we'll compare it to small cap value. So we invested 10 grand in 1972. There you go. Can you guys read that? 6.8 million for small cap, 1.6 for large cap, 1.635 for the market as a whole. So why aren't we all just in small cap value, right? And I think the answer is because we understand the history and we might want some small cap value, but our future lives depend on how our investments do in terms of retirement, let's say, and we're just not confident enough that history will repeat itself. I mean, if we knew that history would repeat itself, yeah, we might do that, but we don't. And so we want more diversification. Okay, why stop at U.S. stocks? So you can see already that we can explain perhaps why we do something, but no matter what your explanation is, there can be a different side to that same issue. Well, I go to the U.S. market, maybe I do that only, or I have some small cap value, but I'm comfortable there and I don't need international exposure. Okay, well, that's your answer. Will it work out going forward? I don't know. Neither do you. No one knows, right? And so another sort of approach is you could look at what an investor that you respect does. And here, I mean, you could pick Vanguard's target date fund and implement it yourself. Paul Merriman, we all know Paul. You could say, well, I'll take his ultimate buy and hold. Maybe you love Ray Dalio. You want his all weather. I'm not a fan of it, but whatever. You could, the Boglehead 3-fund portfolio. And so here, you're kind of just picking something, at least initially, because someone you respect thinks it's a good approach, and you then evaluate it for yourself. You understand why they think that's a good approach, and that resonates with you. right? Now, part of that will be based on historical data, I'm sure, right? But that only gets us so far, I think. So another factor, by the way, is the allocation. A lot of times you need to be diverse enough so that you can stick with that allocation no matter what. And because that's really the big question. Can you stick with this allocation? Because you think of the different asset classes. You can look at, I'll show you this here, asset class performance chart. Is this what it's called? We'll just pull one of these up. Here we go. Let's see if I can make it bigger. But this is, many of you have seen these sorts of charts. These show you the top, well, relative top to bottom asset classes and their returns in a given year. So in 2007, EM is emerging market. And if I just hover over it, I mean, look at that. In 2007, if you had emerging market exposure, you were brilliant. The next year, you were miserable. You're down here. Brilliant, smart, miserable, really smart, miserable, 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 pretty smart, brilliant, right? I mean, it's just, how about REITs? There you go. Look at that from 2010 to 2015. Even given the lower return in 2013, man, you were just on fire. Of course, that came off of one of the biggest housing crashes, real estate crashes we've ever seen. But there you go. How about small cap? So it's had some good and bad years, right? And so my point is that no matter what you do, I don't care what your allocation is, there are going to be aspects of your portfolio that are going to do well in a given year, and of course, some are going to do terrible. Now, if you break all of these asset classes out into individual funds, you'll see that. If you have more, like if you have the 3-fund portfolio, a lot of this will be hidden from you, right? Or even a target date retirement fund that's going to have exposure to all of this. You're just not going to see it. You're going to see as one round number, your performance for a given year. If instead you have like a 12-fund portfolio because you've broken out small cap value, mid cap value, large cap, emerging markets, international small cap, and on and on and on, then you'll see it. But the point is, yeah, I mean, isn't that kind of cool? I don't know. Does that give you a headache? In any event, that's my thinking. So coming back to your question, what was your question? The international exposure. I was comfortable with a total of 25%, 15% developed, 10% emerging. I could see trying to consolidate that. They're now in 2 different funds. I could see trying to consolidate that just from a management perspective into one fund like a VXUS. Which if you do, then you have to remember, you're getting convenience, one fund, but you're giving up the power to decide exactly how much you have in emerging markets, because VXUS decides for you, right? Or whatever total international fund you pick. And so you have to be comfortable with that. I would be. For me, taxes are kind of slowing that change up a little bit. So I was comfortable with that. One answer would be, I'm going to try to mirror the market. But for most people in the US, that would give you more international than you're probably comfortable with. And you could look at like VT, Vanguard Total World Fund, as an example of that. So Justin, he's like, I just wanted to know your percent, Rob. I mean, what was all of that? I don't know. That's how I think about things. Let's see. Salty wants to know if the coffee cup and liquid are fake. No, this is real cup. It's not, it's really here. And it is coffee. It's cold now. I'm thinking about getting a very expensive espresso maker. I don't know. RapFreak says, thanks for the education on Monday about Westland Mall. I'm mid-40s and unaware it used to be an open. Oh, yeah. Yeah. I assume the planter boxes were a style choice. I don't know. Yep. I can remember going there and it was open air. That's how old I am. So GoKU asks, if you invest in 401k to the match, meaning the company match, maxed out Roth, better than go back to the 401k to invest or a taxable account. Oh, he's asking. Okay. So you're contributing to the 401k enough to get the full benefit of the company match. You're maxing out a Roth IRA. Now, do you then go back and finish maxing out the 401k or go to a taxable account? So, and as he points out, taxable account has long-term capital gain tax and early retirement access. Well, yeah, so part of that depends on your plans. But remember, so let's say, generally speaking, I'd want to max out a 401k. If I want to get access to funds early, meaning before 59 and a half, remember, you can take out substantially equal payments from a traditional account without the 10% penalty. Just keep in mind that if you do that, you've got to keep doing it for a period of time. You've mentioned a Roth IRA, right? Yes. So you can always take out those contributions, penalty and tax-free in early retirement. You could move when you retire, move 401k into an IRA, and then do sort of a Roth ladder, Roth conversion ladder. You can Google that to get a lot of information on it. If your early retirement is 55 or older, you can take money out of the 401k at where you worked when you were 55 and retired, not previous employers, and not if you roll it over to an IRA, but there's that 401k rule 55 or 50 age 55 rule. You can Google it, tell you all you need to know. The other thing I would think about, particularly if I'm thinking early retirement down the road, is do I think I can get to a point where I'm maxing out the 401k and then can even invest in taxable, which could be used for early retirement? Maybe you can't do that now, but maybe you're 15 years away from early retirement, just making up numbers, and in 5 years you can do it, you think. So these are the things I'd be thinking about. I do like the tax advantages of a 401k though, so they'd be hard to pass up. So Andrew asks a similar question. At what point would you start investing outside a retirement account if you think you might retire early? So again, I would work hard to max out the benefits of the retirement accounts and then go to taxable. That would be my number one plan. Plan A. If that wasn't going to happen, then again, kind of like what I discussed just a second ago, a lot of it would depend on, do I have Roth IRAs that I can tap? Do I want to do substantially equal periodic payments from a traditional account before I'm 59 and a half? So those would be questions. But again, I would work hard to continue to take advantage of the tax benefits of a retirement account if I could. And remember, some would say, well, wait a minute. If I put money in a traditional 401k, when I take it out, it's taxed as ordinary income. But if I take that money and instead put it in a brokerage account, when I take it out, first of all, it's only the gains because I paid tax on that money before I invested it. And the gains are long-term capital gains. But here's the thing to keep in mind. So let's say you've got $10,000 you could put in a 401k, and that's all you can do. If you put that in the 401k, you don't pay taxes on that. So you get a benefit, right? It could be $2,500, $3,000 in lower taxes that you could then invest in a taxable account. If you don't put that money in a 401k, then it goes through your paycheck, you get taxed on it, and you're left with, I'm just going to make up a number, $7,500 that gets invested. So yes, I understand how these are treated when you take money out is different, but they're also treated differently, when you put money in. And of course, if the 401k is a Roth, then people understand, I think, the tax benefits of a Roth easier because we all get tax-free. We like that. Anyway, that's my thought, Andrew. Vinyl says, if you have a REIT, you get 20% off for Section 199A. Well, Vinyl, do you think that makes REITs ideal for a taxable account? Rap Freak. Question. Thoughts on changing contributions to rebalance? I think it's a great idea. I got heavy on large cap growth last year, and it's a higher amount than I'm comfortable with. So I think it's maybe the first way to rebalance. I mean, if we're talking about avoiding taxes, again, in a retirement account, you can rebalance, it's not an issue. But if you're in a taxable account and one of your asset classes, in this case, growth, is more than you want it to be, then, and you're contributing to it, I would change. Yeah, I would absolutely change those contributions and direct them to, whatever the appropriate asset class is that you've got to bring things back into balance. The other thing I would do is not automatically invest dividends. Let them go to a cash account and reinvest them into, again, whatever fund you need to rebalance. I think it's a great idea. Mary wants to know, do you have expectations, target goals for the returns of your investments, I think is the question, over, say, the next 5 or 10 years? Yeah, thank you. Thank you for the excellence. Well, thank you, Mary. My first thought was maybe she thought she was watching a different show. Yeah. Okay, well, we kind of talked about that a bit, because in new retirement, in setting up your accounts, you have to put in an optimistic rate of return and a pessimistic rate of return. And it's really important. In fact, let me just show you something real quick, just to highlight how important these assumptions are. I'll put it back up to 9, pessimistic at 3, and it also matters on inflation. But one thing is, so if you look at overview, you can change the assumption. So let's go to optimistic. So optimistic, you're going to die at 9. This person in this hypothetical demo account is 45, I think. At 93, they die with a projected 46 million, which ain't bad. That's at 9%, right? If you go to pessimistic, they run out of money. That's how bad it is. And if you go to average, they don't run out of money, but boy, they end up with a lot less, right? Well, that sort of analysis, I think, is kind of obvious. Yes, of course, Rob, if we assume a different, rate of return, then, even if assuming you don't run out of money, you're going to end up with more or less, right? Got it. But here's where things get interesting. Let's go down to the Roth Conversion Explorer. So let's first start with optimistic. So again, because it's optimistic, remember, we're assuming 9% is optimistic. The traditional IRA is growing a lot. And so the RMDs are going to be high. And so it justifies a lot of conversions. And the blue bar represents the suggested conversions over time. And you might say, well, wait a minute, why are we waiting to 2036? I don't know how well you can see that number, but that's 2036. And without digging into the numbers, my assumption is it's because that's when you retire and your income goes down, so your tax brackets go down. But what if we assume even just average returns? Big difference, right? Big difference in the conversion. And if we go pessimistic, I think just the wheels fall off and we've got trouble. It doesn't suggest any conversions because our money doesn't grow that much. So it's a really important, the assumptions. By the way, the other thing you can do, I'll show you on Monday. Enough of that for today. So but having said that, in terms of like the next 5 to 10 years, I don't really have any assumptions. I don't think about it that way. I think about it from a planning perspective, as I just showed you, and that's over, for me, like a 40-year time period. It's kind of sad to say. In any event, but yeah, I don't think about it. Let's put it this way: there's nothing. It's not going to change anything. I can think about it from just boy, this is kind of interesting, but it's not going to change how I invest. Now, my friend Joe, it does. He thinks we're heading to stagflation. He's a big Stansberry guy. He emails me Stansberry's newsletters every now and again, or an article. And so he's big into that. He's just stunned that I'm not buying puts or whatever, or an inverse ETF. So he and I just think differently. But by the way, it's not that I don't think we could be in for hard times. I think we could be, for sure. It's just how he and I handle that differently. And it could be, by the way, that the way he handles it will end up being better than the way I handled it. But it just doesn't affect how I invest. So having said that, Mary, if I were going to make a guess, say over the next 10 years, my guess would be that stocks would look more like the first decade of this century, which were basically flat. That would be my guess. For bonds, depends what bonds we're talking about. But if we're talking about like intermediate term bonds, I'm going to guess we're, over the next, let's say 7 years, we'll be at whatever the yield is today, which is not great. That'll be the average return. So if we go to BMD, its yield right now is around 2, I think. Maybe it's less than that. No, it's 2. Well, 12 months is 2. SEC yield. I think that would be, over the duration of this fund, which is around 7 years. Let's see. Yeah, 6.84. If I had to guess, I would say the total return of this fund over the next 7 years would be that's as good a guess as any. Hope that wasn't too depressing. By the way, if you're young and you think about the stock market crashing, it's the best thing that could ever happen to you. You just keep investing in the 401k, the IRA, everything else. You're buying cheaper and cheaper. The last thing you want is for the past decade to repeat itself, because you'll just be buying at bigger and higher prices. Mark says, have you noticed a difference in timing of receipts from one brokerage to another? Pershing puts dividends in account a day before Vanguard. Oh, that's interesting. No, I haven't really focused on that. Yeah, I haven't. That's interesting. I don't know why that would be, but maybe once I'm living off dividends, that might be more. Maybe I'll pay more attention to that. James says, I have a load of US in my taxable account. Now, that's a technical term, load. He's got a load. Because I can only contribute $6K a year to a Roth, no 401k. Okay. With VTIAX, total market, having unqualified dividends. I wouldn't think it has many, though. Am I putting all the international in my Roth to do a 3-fund portfolio? Okay, let's think about this. So you have no 401k, you have a Roth and a taxable. Well, you're going to have non-qualified dividends in an international fund too, and probably more, but you're also going to get, as some readers pointed out to me, a credit for foreign taxes paid, which could offset the taxes on the non-qualified dividends in an international account, but not necessarily. A lot of that will depend, I think, on your tax bracket. But if we go to, I'll put this on the screen. Let's look at VTIAX. So this won't tell us qualified versus non-qualified, I don't think. No. But like, so it didn't pay much, $1 on a 33 NAV stock last year. I'm trying to think about my ownership of this. I think the non-qualified was a very small amount, James. That's my memory. I could actually find my tax document and look, but it's not handy. Sorry. I don't think it was significant. Someone correct me. Maybe someone's got to know this. I don't think that the non-qualified, and for those wondering why this is an issue, for qualified dividends, they're taxed as long-term capital gains. If they're not qualified, they're ordinary income. This is an interesting question from Roth. Cost basis, how to figure it out if you bought something 30 years ago and broker says does not have it, doesn't know it. I have no idea. And I don't know what the consequences are. Although if it was 30 years ago, I'm going to guess the large majority of it is gains, I would think and hope. I mean, do you know when you bought it? If you have a record of when you bought it, you could maybe reconstruct your basis, right? If you know the price, that it was trading at that day, assuming we're talking about something publicly traded. Of course, if you have dividends, if they get reinvested, that complicates it all. But I don't have an answer beyond that. Andy, greetings from Portland. My 401k offers FTBFX as an index bond fund, but is it worth the 45 basis points? Yeah, it might be. I like that answer. Such a lawyerly answer. Maybe. So one could argue, so this would be an actively managed fund, right? Many think that active management, if there's a place for it, it's in fixed income. So let's look at the portfolio. So its duration is similar to BND, right? So let's do this. We're going to go to Portfolio Visualizer. And we'll put these two funds. So again, you've got FTBFX. I like this fund. I mean, I don't own it, I don't think. No, I don't. Whoops. See how much data we get. Oh, not bad. Keep in mind that Portfolio Visualizer, the returns incorporate the expense ratio. They do not incorporate sales charges. So like if you bought an American Funds, A share where you paid 5.75% fee, wouldn't cover that. But these don't have a sales charge. So it's actually outperformed over the last, what did I say, 12 years? 14 years. I like to look, we can look at rolling periods, but I like to look at annual. So here, this is a perfect example. Okay, well, I don't know what happened that year. Something big happened. I don't know what was going on in 2009. Let me just make sure. Yeah, it's a broad-based fund. So what I would do, going back to Portfolio Visualizer, is I would start the analysis in 2010. If there's some really outperformance or underperformance for that matter, not that this couldn't happen again, but I'd want to go back and understand why 2009 was such a big year for that fund. That doesn't make sense to me, and 2008 doesn't make sense to me, why they're so different. Of course, that was a difficult times. I mean, it's just a crazy market. But I might come back and say, okay, let's limit this to 2010 and run the numbers again. And this time, well, Fidelity still outperforms. So when I look at this, I think, of course, again, no one knows what the future is going to hold, but I would have no problems owning that fund personally. By the way, I'd have no problems owning the Vanguard fund, even though it's slightly underperformed, because they're both covering effectively the same or very similar asset class, as far as I can tell. Similar durations. I guess Vanguard, let's see. Let me pull up BND. We've looked at it many times. Yeah, it's similar durations. Fidelity 6.12, and we just saw BND a minute ago, I think. Slightly longer, 6.84, but I mean, they're very similar. High investment grade. Does Fidelity, maybe Fidelity, that's what it is. Yeah, I just remembered. So the one difference is, so BBB and up would be investment grade. You can see down here, this 7.47, 6.06. There's some junk bonds in this Fidelity fund, and that could explain the outperformance. Vanguard doesn't have any, right? I don't think it makes it bad or better. Some could argue this is maybe even a little more diverse. But that probably could explain that's what explains. I'm glad I remembered that. I've looked at that fund now that it's all coming back to me. That could explain some of what's going on here. 2008 was like the wheels are coming off as we know it, so their exposure to junk bonds just cratered. And then after March of 2009, it was like, happy days are here again, and so their junk bonds came back. That's my guess. It's just a guess. I could be wrong, but I think they're both good funds. In some ways, there's part of me that would say I kind of favor Fidelity a little bit, even though I'm not a big junk bond fan. I don't have high yield bonds, but that's a relatively small exposure. That might not be bad. So Red wants to know, do the money market funds that Fidelity puts cash in by default actually make money, or are they more of a placeholder? They're more of a placeholder. I mean, they're making a basis point. I don't know. I mean, you could look in your account, but if you have cash that you want to hold in a taxable account, like as an emergency fund, let's say, you're better off in a high yield savings account. Maybe there's some high yield checking accounts. You could do a municipal bond fund depending on your tax bracket and where you live. Of course, you may be keeping it there just for the short term, and you're going to do something with it. In that case, I think it's perfectly fine. But you're not. At least the money market funds that I have and have used, they're not making anything. Keith wants to know, when you invest in tips, do you prefer short-term or something else? Generally speaking, although I still have short-term bonds that I just haven't gotten around. I know you're like, Rob, why you keep talking about moving your short-term to intermediate term, but you haven't done it. You've been talking about it for like a month. I mean, how busy can you be there? I mean, after the show's over, what do you do? Well, there's chess games to play. I mean, it's all very complicated. I work out every now and again, even though I hurt my knee. That's not good. Anyway, I prefer intermediate term. It's just, it's like, it's too hot, it's too cold, it's just perfect. Long term has too much interest rate risk, at least now. Short term doesn't make anything really. And so I tend to go with intermediate term, and that's true for tips and nominal bonds, Keith. I don't think it's the only right answer. One could certainly argue for shorter term. For what it's worth, Bingen's analysis on the 4% rule used intermediate term. By the way, I don't think that makes it better, but when you're thinking about retirement and the 4% rule, that's what he used. So that's generally what I use, even though I do have some allocation to short term. I'm just going to stop telling you guys that because I feel like an idiot that I haven't actually. I mean, it's like it take me 5 minutes. Anyway, Clarice, welcome back. What is your asset allocation for U.S. versus international equities? So my overall asset allocation is 80% stocks, 20% bonds, and I've got of the entire amount, 25% is in. So I got 20% in bonds, fixed income, 25% in international. So what's that? 45, and then 55% in U.S. stocks. What can Rob Berger do? Chess master and investor. Well, I am definitely an investor. I wish I was a chess master. I am not. And I could show you some games I've played to prove it. All right, Daniel. My employer doesn't offer a 401k. I already max out HSA and an IRA. I have no other income except my wages. Is there any other way to invest in a 401k with tax advantages versus a taxable account? No, not that I know of, right? Because you can't open up, only a business can open up a 401k. Now, if you had side income, a side hustle, I don't know, you started a YouTube channel, for example, you could open up either a SEP IRA, it's probably what most, I would guess, open up because they're the easiest, or a solo 401k. But you say you have no other income but your W-2 job, your employer doesn't offer a 401k, you're already maxing out HSAs and IRAs. To my knowledge, taxable accounts are anything that's left. Unless I'm missing something, which is always possible. One thing you could do is talk to your employer. Hey, how about a 401k? Might not happen overnight, but it might happen. But I think a taxable account's anything that's left. I can't think of anything else. Again, assuming no side income. I tell you, from a tax perspective and retirement perspective, side income is, if you can generate it, a huge benefit. I kind of fell into it by luck. Luck may not be the right word, but like when I started my blog back in 2007, I wasn't thinking, oh, I'm going to build this into a business and I'm going to have a SEP IRA and I've got these tax deductions. It was more like, hey, I bet starting a website would be fun. I like talking about investing. Let's do it. That was it. That was my full analysis. I didn't even have to use a PowerPoint to create it. So in that sense, I guess I got lucky. But yeah, side income, if you can generate it, lots of advantages. Here we go. G. Branding, I'm having a hard time convincing siblings and friends in the early 20s to start investing. How do you have the talk with your kids? Well, it's kids, you're going to invest. What else you want to know? It is a challenge. And certainly having, if they have access to a 401k, I think that makes it a little easier because they don't have to decide where to open the account. It comes out of their paycheck. You can tell them, start with $25 a paycheck. Don't try to get them into saving 30% of their income. You can start small. And the reality is they don't even miss it. And the interesting thing for one of our kids was that where they work, they started with a 401k. They weren't maxing it out, but it was one of those deals where they automatically increase it every year. And he kind of just lived with it. It's like, okay. And now they're saving quite a lot, and it was sort of gradual, and it didn't hurt. You could talk to them about compounding, because I think a lot of people don't appreciate it. If you just ask someone off the street who's in their 20s, how much would you have to save each month if you wanted to be a millionaire by the time you retired? You're going to get crazy answers, but we know it's not much, assuming let's say an 8% return, a few $100, right? And you're there. And people our mind just doesn't work that way. And so maybe that could help, but I do find talking about compounding can be very helpful. And again, just get them doing a small amount to start with. That's what I've done. So AV from the Netherlands, welcome. Do you have a suggestion for a 3-group dividend ETF? I'm not sure what that means. 3-group, like a 3-fund? I mean, for a 3-fund, I wouldn't focus on dividend ETF. I mean, the stock dividends in a 3-fund the stock ETFs in a 3-fund portfolio pay dividends. They don't focus on the dividend aspect. It's just total market, total U.S. market, total international market, total bond. In our case, total U.S. bond. In the Netherlands, you might choose something else. They don't focus on dividends. And I'll show you a great site. If this is your question, 3-group, I'm not sure, and dividends throws me a little bit. But if you Google 3-fund portfolio, there's 2 resources I would recommend. One is my own site, which is this. And I just walk through what it is, how to build it, do some portfolio visualizer analysis and whatnot. The other article that I like is at the Bogleheads. So it is specific to U.S. investors, so I don't have anything specific to the Netherlands, I'm afraid. But one of the things I like about this article is they give you specific fund ideas. These are all mutual funds, and then these are all exchange traded funds, ETFs. So, and if that's not your question, just let me know. Salty, I will look. I know the misery index. I'll look it up for the stagflation definition. Okay. Stephen, do you include retirement accounts when calculating cash percentage of portfolio? My position is 10% cash, including retirement accounts, but 25% cash without retirement. Okay, I think I understand this. So whenever I calculate my asset allocation, I include anything that I'm saving long-term. So it can be in a retirement account, traditional or Roth, can be in an HSA, could be in a taxable account. If this is like saving for retirement or for some undefined period in the future, I include it. So what that means is I don't include my checking account, which has cash. If I'm saving up to remodel the kitchen or take a vacation, that's cash, but I wouldn't include that. So that's how I do it. So to your question, yes, I would include a retirement account because I'm saving that for the long term. Yeah. Esteban says, watching this live while working from work. All right, I like it. Oh, Andy, CS account, Charles Schwab. Maybe. I don't know. Or, yeah, I don't know. Okay. I know Monday you review some small cap funds, one from Vanguard, one from Fidelity. Could you please review and assess? This is from Florida Flash. 2 funds. Sure. Let's take a look at them. I'll put it up on the screen. First one is, I think we've looked at this, FISVX. Oh, it's just a small cap index fund. All right. And the other one, pull it up and then we'll look at them, FSSNX. So one thing you can do, when you look at something like this, let me actually, hang on for a second. I'm gonna Google this ticker and pull it up on Fidelity for a second. So we're looking, let's see, it's this one and this one are the same, right? This is in Morningstar. One of the things in comparing 2 index funds is to figure out what index the fund tracks, right? And so normally, I don't know that that information is available on Morningstar that I've seen. Maybe it is, I just don't know where. Normally, you'll find it on the fund's website, right? So, so for this one, and I think with Fidelity, it's down here. Yeah, so this is basically tracking the Russell 2000 value index, right? Not 100%, but that's what it's tracking. So this one, yeah, so this, and that makes sense, it's a value fund. This one's not a value fund, right? So let me pull that one up in Fidelity. Here it is. So this one, going to track it. It could be the Russell 2000. Yeah, it's the Russell 2000, just not the value. So that's the difference, right? Now, why do I bring all that up? Because if you want to compare a fund like one of these funds, say a Vanguard fund, for example, if they're both tracking the Russell 2000, then they're more or less the same. They're not going to be identical because there can be, you know, they can have slightly different methodologies for tracking the index. And so you could, and of course there could be fees that are different, but you might see slight differences in the performance, but it shouldn't be significant unless one of the funds is really doing something wrong. So in any event, going back to the 2 funds, so this would be, we've talked a lot about, we looked at earlier at small cap value. I mean, its performance over the last 4 or 5 decades has been phenomenal. It has its periods where it's not phenomenal, but it's done really, really well. And if we look at the portfolio, we can compare it to just the straight up small cap index. But again, this is small cap. It's in that bottom row, and it's value, meaning it's in this left column. It's just a Morningstar style box. You can look at weights. Don't be surprised that you see some mid cap. That's normal. And of course, you see some growth over here. 9% is in small cap growth, but you know, its overall weight is value. And this would be a perfectly good fund to invest in if you wanted a small cap value exposure, right? This one would be if you just want overall small cap. I think it's a good fund too. Historically, I've sort of tilted my small cap to value, although I have a small cap index fund as well. But you can see the difference. And if we look at weights, again, it's going to have a little bit of mid cap, but it's small cap distribution. It's got more growth. We can look at performance. Actually, performance for the growth fund the small cap index fund might be a little better because value has suffered a bit. So let's just look at this. So the performance is here. Let's look at 2020. So this is small cap index, 20%, right? And if we go to the value fund, this is small cap value. Yeah, significant. I'm surprised it's that different, although it could have been a partial year. I wonder when this fund launched, since it doesn't have 2019 data. But for 2021, 28%. And I'm surprised at the differences, actually. That really surprises me. That's a big difference. This year it's lost 10%, and this one's lost 5%. So it's another good example of why you need to pick an approach and stick with it. I think either approach would be perfectly reasonable. Historically, I've tilted towards value. But I think these are both good funds. All right. Connor wants to know, good morning. What do you think about value coming back and outperforming growth in the 2020s? Is it just a dream or does it seem realistic? Well, whether it's a dream or not, I suppose depends on your perspective. I'm pretty confident Kathy would hope that doesn't happen. I mean, really, I think the question is inflation and interest rates. That's going to drive, I think, the relative performance of growth in value. And I don't see how interest rates at some point don't start to rise. The Fed is supposedly going to lift the Fed funds rate 6 times this year. I heard one person think they're going to do it 7. Not that necessarily drives longer term rates. That a lot of different things affect that. But if I had to guess, Connor, I think value will outperform growth this decade. Ah, 613. Good morning. I think I heard you mention previously that you moved money away from Vanguard. What brokers did you move the money to, and do you still have some at Vanguard? Thanks. Well, let me kind of answer that in a roundabout way. So I'll tell you some of the brokers that I like. I like Fidelity. I like Vanguard. I'm not Vanguard. I like Schwab. I like M1 Finance, although it's a different kind of broker. I like some of the robos, actually, even though they have an extra fee that you got to factor in. But I like Betterment. I like Wealthfront. Vanguard has not been my favorite. I'm not happy with some of their technology. I'm not happy with some of their customer service. I'm thrilled with their funds, but I wasn't thrilled with the service probably more than anything else, but to some extent their technology. But by the way, like if you're holding an IRA at Vanguard, I'm not suggesting for a minute that you should move it. But particularly as you get nearer to retirement and things tend to get more complicated, right? You may have over time have a lot more accounts than when you're in your 20s. You're thinking about RMDs, distributions, taking money out. What cash management features does the broker have? Do you want to? Maybe they're a bank too, and you can have your checking account there. Merrill Edge is another one that I think is a perfectly good broker, and they're associated part of Bank of America, so you've got this built-in bank that you can deal with cash management. So I think as you near retirement, these sorts of things come into play. And I'm just not sure that Vanguard is best suited for that, at least not for me. So Esteban, Rob, I did have 2 questions. Is there any issue with holding VTI in a Fidelity Roth IRA? Not that I can think of. And if not, should I invest in VTI or FSKAX? Is that the Fidelity? That must be the Fidelity total market. The ticker sounds familiar. Yeah. That's actually one that's probably cheaper, right? Let's look at this. It's 1.5 basis points. VTI, I think, is 3, isn't it? Yeah, 3 basis points. But to answer your question, I honestly don't think it matters. Pick one. That's my answer. I mean, if we can look at them here. I don't know how much data we have. Just make sure I get the ticker right. FSKAX. I got 10 years, 11 years. Yeah, I mean, Fidelity's outperformed by about $100, 3 basis points. I mean, you can look at it year to year. It really doesn't matter. Mike 21074, you're welcome. Appreciate the kind words. Alex, hey Rob, I'm from Texas. I'm 40 years old, single, and shooting to retire at 55. What's a reasonable percentage of total investments between my 401k, Roth IRA, and taxable accounts? Thank you, Rob. Well, I don't know that the early retirement will matter much into that question, which may sound odd. So first of all, if you retire at 55 or older, you can take money out of the 401k at the job you left. And again, we talked about that, the age 55 401k rule. You can Google it. You won't pay 10% penalty. And I'm just double check. You've got a Roth IRA, so you can always take out contributions, penalty and tax free. You've got money in a taxable account. You've only got to get, 4.5 years till you get to 59. So, not knowing anything about your specific circumstances, of course, which could change everything, I think I would be personally maxing out the retirement benefits of a Roth IRA and a 401k first. And if your 401k happens to be a Roth, well, I don't know. You didn't say. I'm guessing it's not. But in any event, I would be maxing out those tax advantages because, again, to avoid the real issue is only before you're 59 and a half. But you're going to retire at 55, so it's not that long. And you said Roth IRAs and taxable accounts. So, I mean, the question is, can you cover your expenses with those? Because normally the way there are exceptions to this, but normally in retirement, how would you, at 55, you retire, what do you do? Well, you'd spend your dividends and interest from your taxable account first, right? And then again, always exceptions, but as sort of a general rule of thumb, you'd then spend, to the extent dividends and interest didn't cover your expenses, you'd spend money out of your taxable account. You'd pay, long-term, hopefully, capital gains on any gains from the sale. But again, the sale is going to include cost basis, presumably, so it won't 100% be taxed. And then eventually you go to your traditional, if you can, and then after that to your Roth. Again, always exceptions to all of this, but so if your taxable accounts can get you through the first 4.5 years, you got that. If they can't, then if your 401k is at your current employer, you retire at 55 or older, you can take money out. Again, Google the rule, age 55 rule, to make sure you follow all of the requirements, but without paying the 10% penalty. So that could help you bridge the gap too. That's how I would think about it. Quincy says the market is down. What? That is an outrage. Can't possibly be true. That's what my phone looks like. Lots and lots of red. Is anything green? Deer's green. Verizon's green. Caterpillar. I see, apart from Verizon, I see a theme, Caterpillar and deer. Nothing runs like a deer. So this is Mr. Dan, and he starts out GM from CA. Does that mean you're a grandmaster and you live in California? That's what I want to know. Maybe you're a general manager. I don't know. The TDF, Target Date Fund, I'm currently in has reached an allocation I don't want to go below, 65-35. So would moving to the next TDF be the simplest, best plan? Would appreciate your thoughts. Assuming you're in a retirement account, so there's no tax issues. I think it's a perfectly great plan. There's no rule that says the target date fund you invest in that the year in the fund name has to match when you're going to retire, right? So I like to say there's no target date fund police that will come and arrest you because you've put your money in a 2045 fund, even though you plan to retire in 2040. So yeah, I think it's a perfectly reasonable approach. Man, lots of questions. I'm just looking. I'm not going to get to the end. Okay. I've answered that one. That's good. Joker, what are your thoughts on GVIP, which is Goldman Sachs Hedge Fund Industry Index ETF? My guess is it's expensive. GVIP. Here it is. It's only 45 basis points. I don't know a thing about this fund. What's its portfolio? I don't know. That's my answer, Joker. I would have to do a deep dive on this. I have no earthly idea. I don't quite understand the hedge fund angle. Hedge industry. Okay, hang on. We got to get to the bottom of this. Here's the Goldman Sachs. So it seeks to track, you probably can't read that, but I'll make it a little bigger. Seeks to track the GS, Goldman Sachs, Hedge Fund VIP Index, which is constructed in accordance with a rules-based methodology derived from concepts previously developed by Goldman Sachs Global Investment Research Division. The index consists of fundamentally driven hedge fund managers, very important positions, which appear most frequently among their top 10 long equity holdings. That's interesting. Makes me a little nervous. Hedge funds don't always have a great record. So I'm not sure why one would necessarily want to blindly follow them. And I shouldn't say they're blindly following them. I wonder how it's performed. Oops. GVIP. I wonder, there may not be much data. Yeah, 5 years. It's slightly outperformed the total stock market. Not by much, but it has by $1,000. Yeah, I would have to take a deeper dive on it. I mean, part of my thinking on a fund like that is why. What question is it answering? What need is it filling? What problem is it solving? I mean, I suppose you could say, well, I just think it's a good investment, although it doesn't have much history. So it's kind of hard to tell. And it strikes me as I personally would be much more comfortable just following a broader based index. But I've literally spent all of 40 seconds looking at it. Yeah, that one would require a deeper dive. Okay, Ron says, if you were earning a salary, having you able to each year save 5 years of living expenses. Wow. Okay. Would you leave if you disliked the job or stay until totally unbearable? Sort of one more year syndrome. Well, so the first question is what your ultimate goal is and how long do you have to stay at this job you hate to meet your goal? In other words, if you said, well, look, if I just stick it out, I'm 40, and if I just stick it out 2 more years, I can retire. Then that would, to me, that would favor staying, but depending on just how and why it's so unbearable. So because that gets to my next thought is, can you make it less painful? Is it unbearable because of the person that sits next to you? Is it unbearable because of the business you're in, your manager? Why is it unbearable? Can you get away from that? Or soften the blow? Those are questions. And saving 5 years of living expenses, you obviously live well below your means. And so then the question becomes, do you really need the money? Now, I mean, maybe you can leave, you're not going to retire yet, but you can leave and take a big pay cut. I will tell you that I took 2 pay cuts in my career. When I left Winston, I was a partner at Winston & Strawn. I left, took a big pay cut to go in-house. And then 2.5 years later, I went to the government. Technically, it's not the government, but the Public Company Accounting Oversight Board, and took another sizable pay cut. And both decisions were 2 of the best decisions I made in my career. Now, of course, that doesn't tell you what you should do. but they were two of the best decisions I made, and really changed the course of not just my career, but my life in very positive ways. And by the way, I really enjoyed Winston and Strawn. It wasn't like I was in some unbearable situation. I enjoyed working there, enjoyed the people I worked with, but there are certain realities to that kind of job. Large law firm, litigation work that are hard to escape without leaving. And I don't regret it at all. Salty wants me to speak about Medigap insurance, but I'm not sure what he wants me to say. Please also talk about short-term insurance for early retirement. I don't know what short-term insurance for early retirement is. Health insurance? In terms of Medigap insurance, I am not at all an expert in Medigap because I don't need it yet. So I know what it is, but I haven't spent time studying it and what I would do. I can tell you that New Retirement does model a lot of those different things. But if you have a specific question about Medigap insurance, Salty, let me know. Russell wants to know what the key switches are. I'm not sure. I mean, like when I go up here and I do this, and then this, can I raise it now? I didn't want to do it before. There it is. It's just a stream switcher. So I can do everything real time. Hopefully I haven't inadvertently unplugged something. By the way, it's a Roland VR-1 HD. All right. This is an interesting question from Devin. If you're doing the standard Boglehead 3-fund portfolio and aiming to retire early, is it worth moving all money from Schwab to Vanguard just to avoid the dividends taxes? I'm not following that. Why would where you hold the investment affect the taxes on dividends? I don't think it would, Devin, unless I'm missing something. So I guess a question back to you. Why do you think holding the assets at Vanguard would lessen the dividends that are distributed to you and the taxes you would pay on them? Or I am misunderstanding your question. Keith asks what I think is arguably maybe the best question of the day. Thanks for your time and sharing your wisdom. If you make and execute your investment decisions from a leopard skinned chair, how much does it improve your returns? Not at all, actually. Yeah, I need my chair back. You might have figured out that this is actually my wife's chair. You should see the carpet. I wish I could show it to you, but that's not possible. I'll just say this. Matches the chair. All right. Welcome to my world. It's a good one, by the way. All right. Happy Thursday. This is from Nicholas. What do you think is a good percentage to invest in the Wilshire 4500? Well, these are interesting questions. 60% mid cap and 40% small cap. Right now, I have 75% S&P 500, 25% Wilshire 4500. Well, so the first question, Nicholas, is why not go with a total stock market fund, right? Which, of course, includes mid cap and small cap. So if we look up, we'll just do VTI. And we go to the portfolio. Whoops, here we go. And this is where, the style map itself doesn't help you. You want to look at weights. So this is the weight of the market as a whole, US market. So you've got, 20%, 19% mid cap, 10, or I guess that's 9% small cap. So, the first question is, why wouldn't this be good enough, right? Now, one answer to that might be, well, Rob, I want to overweight mid cap and small cap. I'm a big believer in that. That's just what I want to do. So if you're going to do that with an S&P, let's see, you got an S&P 500. That's going to cover the large cap, right? So to my way of thinking, Or I suppose, by the way, you could, now that I think about it, you could say, I don't want to increase this. I want to decrease it. I don't want this much, right? So that gets you to your answer, right? For your fund, because do you want the mid cap and small cap exposure to be greater than a total market or less? If you want it to be the same, well, that answers your question too. It just raises another one. Why not just go with the total stock market fund? But if you want it to be more than this, then you could dial up the Wilshire 4500, which I don't even know what funds track that, but I'm sure they're out there. In any event, so that you've increased the allocation to mid cap and small cap above the market to whatever you want, right? I mean, whatever your thinking is. So, and another way to look at it too. So let me see here. Let me pull this off for just a second. I'm trying to look up a fund. I think DVY is an example. Yeah, DVY. So what we can do, we can model this here. So we can say, okay, we've got DVY. I don't know what, you didn't mention what fund. I'm pretty sure this is a Wilshire 4000 fund. And you've got, we'll just use VU for the 500. And we're going to compare it to VTI. So right now you said you were 25% here and 75% S&P. And if we analyze the portfolios, my thinking here is not returns, which interestingly enough are identical, but that's interesting. So what this tells me, I mean, it's almost, I mean, there are only 3 basis points different. This tells me that these two allocations, that is to say, just taking a total market versus these two funds at 25 for the Wilshire and 7,500 for the S&P, are almost identical, right? Now, we can look at, let's see, yeah. So you can, if you hit exposure here, you can actually go through the different asset classes and look at them. Portfolio 1 being total market. And you'll see some differences. And you can see there's more mid-cap value in this fund. So this may not be the fund you're using. This looks like it has a value tilt maybe. It has more 10% here, whereas this fund has mid-cap in 2 different categories, value and growth. It comes close to the 10.71%, almost identical. So these two allocations, very, very similar. Now, again, you didn't tell me which tickers you're using. So particularly for your Wilshire. So it could be very different. I wouldn't say very different, but it could be different. So it looks to me like there's a good chance what you're doing is basically mirroring the market with 2 funds instead of 1. But really the bigger point is use Portfolio Visualizer. Put your allocation in here with whatever funds you're using, like I've done, and compare it to VTI. You could learn a lot, I think, about your portfolio and then maybe start to think about decisions you might want to make. Again, whether you want to have some overweight to mid and small cap or underweight, right? There's arguments both ways. Buffett would be underweight. He would be S&P 500. What does he know? He knows a few things. See, he invested in Occidental. Anyway, all right, I got time for one more question. Let's see. Prescott was referring to Charles Schwab, but now I do not remember the question. I don't think there's an easy way for me to find it. And that was like an hour and 40 minutes ago, so I am so sorry. Let me think. I can picture it. I just can't quite remember the question. Here's a good question from Lisa. By the way, I'm going to tell you up front, I have no idea what the answer is, but it's a great question. There's all this talk about the US dollar losing reserve status. If this happens, how will that affect the stocks? Well, and by the way, I assume you mean US stocks. Could actually help my international exposure, I suppose. It's interesting because a lot of commodities are traded in US dollars. And I do wonder, if we lost reserve status, would that change? What would that look like? I think so I'm not an expert in this at all. I'm just, so just assume what I'm going to say is wrong. But I do wonder if that would increase the cost of our borrowing. I mean, we're borrowing in US dollars. And I don't think that would change. I can't imagine that changing. But because our currency is, considered stable, I mean, it's used around the world. And if that were to change, and fewer people were to invest in our currency and our debt, I could see that having a big impact on interest rates, I think, which in turn could have a big impact on stocks. But having said all of that, I also may not know what in the heck I'm talking about. I also, at least if you're reading the tea leaves, I don't see that happening anytime soon. Of course, maybe it's a black swan event. By definition, we don't see it happening, and by July, it's out. I don't know. But I really don't. I don't see that. I don't see what other currencies, unless it's a basket of currencies, would take over. In long term, you think decades. I mean, anything can happen. But all right, one more. I'm gonna answer one more question because it's an important one from Paul. What was all that phishing comments on the last video comment? So let me show you that. People try to pretend like they're me in comments to my videos. And it's a problem that YouTube generally has. And by the way, I try to delete them, but I could literally, I can either turn off the comments, which I don't want to do. At one point I was manually approving them all, but there's just no way I can do that. Let me show you. I'll show you behind the scenes. This is what I see when I log in and I look at comments. By the way, almost to 50,000 subscribers. So remember, subscribe early, subscribe often. All right, so here's I can go to a comment section. I see all my comments. So whenever I see this, so you got a comment, 34 likes of the comment and all of this, I know without question, and this is not what Paul's referring to, but this is a spam comment. They're trying to promote some advisor. Here we go. Invest with Mrs. Fiona. Right. So I just come up here and I used to report it, but there's no point because YouTube doesn't do anything as far as I can tell. So I just hide the user from the channel and it's gone. The problem is the spammers just create new accounts all the time. So let's oh, look, now I can't find one. There we go. There it is right there. WhatsApp, there's a number, my picture, feedback appreciated. Wanting more info and insight, WhatsApp, the number above, right? So I'm hoping when people see this, they're like, yeah, I don't think that's Rob. Now, again, and then you see scammer. So I didn't delete this one because Super Steve said scammer be phishing. So he's sort of alerting people. I even like that comment. Here's another one. So, I delete them. I didn't delete these because Steve outed them, but generally I delete them. But there's no way. I just can't. There's just no way I can stay on top of it. So unfortunately, that is a reality of YouTube. Yeah. Well, listen, 2 hours goes by quick. At least for me. Maybe it was the slowest, most painful 2 hours you've ever spent in your life, but for me, it went by pretty quick. So again, Monday night, 7 p.m. Eastern time, we're going to be sort of working together through the new retirement tool, but also using it as a sort of a launching pad to discuss issues that come up, and it covers everything in retirement planning, whether you're saving for retirement, or I think it's really where it really pays off is as you near retirement and enter retirement and you're planning, Roth conversions and just how you're going to spend and all of that, your money. So we'll do that Monday night, and hopefully it's good. We'll see. And I may do that more, not new retirement, but other tools, or maybe we'll do a book club. I'll pick a book, and we'll all read it, and then we'll do a live session where we just talk about the book. Actually, I like that idea. All right. Well, that's it. That's what I got for you today. Hope you have a great week, and until next time, remember, the best thing money can buy is financial freedom.